Please subscribe, like, and hit that notification bell. Thanks, guys. You want to do the intro, Kev?
And if you like, yeah. Okay. Okay, guys, it's Kevin Wadsworth and Patrick Crew from NorthStarBadCharts.com. And we're really pleased to be able to welcome Keith Weiner from Monetary Metals to the show today. Keith, how are you doing?
Doing good. How about you?
Not too bad. We're all eyes on precious metals and the rest of the markets at the moment, but we're here to talk, I think, primarily about precious metals, gold, silver, and their role in our financial system as a whole. I thought actually I'd just start off with a chart just to perhaps get the conversation going. So I'm going to share my screen, and if Pat actually enables the screen sharing for me, I'll just show a chart that might get a few people just to have a little think about things from a different perspective. Okay, there we go. So we're looking at the cost of US houses in the US since 1975, I think that is there. So over roughly 50 years or so. And you can see that US house prices up something in excess of 1,000%. So I think we all know house prices have risen over the years. But the question is, have house prices actually risen? Well, that sounds like a stupid question, doesn't it? But I don't think it's quite such a stupid question because it depends how you're actually paying for your houses. If you're paying in US dollars, then it's not so much that the house price has gone up; it's that the US dollar has gone down, and that's clearly illustrated here by houses priced in gold. And in fact, if you use what I would view as a superior store of value and a superior um, technique, if you like, for using money or defining money, then it's 242 ounces of gold is what it was roughly 50 years ago, and it's 242 ounces of gold now. So if you're paying for your house with gold, although it fluctuates up and down, the net effect is a sideways move over the last 50 years. So in answer to the original question, house prices have really pretty much stayed the same for 50 years. You got any comments you'd like to make on that statement, Keith?
Yeah, so I argue, if I can share my screen, I can show one of my favorite charts. I think I put this together for my debate on Bitcoin. How do I share? Can I share my screen? Is that possible?
It should be, yeah. If you click on share screen, it will give you an option of which screen you want to share. There should be a share screen option on your either in your share tray if you're using a Mac or just at the bottom of the
Yeah, in the security. If you click on security, the little shield. Oh, there you go. No?
Okay, let me see if I can. I just want to
Oh,
see.
no, it's not security. You're right, Kara.
Okay.
There you go.
Oh, wait a minute. You know what I need to do? I need to email this to you.
can do
Um,
that. Yeah, that's one way of doing it.
can you email these gentlemen the price of gold chart? So I'll describe it anyway while Steve emails it to you. So I posted this chart at the beginning of this gold versus Bitcoin debate, and it's called the price of 1 ounce of gold from 3000 BC to present. And there's a flat line at 1 ounce. And that 1 ounce of gold has always cost 1 ounce of gold. And I said, no, this isn't just haha, a tautology. This is actually saying something. And that is that in all normal commodities, we say that they have a marginal utility that diminishes as quantity increases. So imagine that you're walking through the desert here in Phoenix or outside of Phoenix here in the summer. It can be 50 degrees centigrade and 5% humidity in the shade, in the sun, probably another plus 15 to 20. And fairly quickly, you would be thirsting to death. So imagine that you're thirsting to death and you're trudging along. You don't know how much longer you can continue. And you come across a guy with a pickup truck selling jugs of water off his tailgate. What would you be willing to pay for the first liter of water? It's your life. You would empty your pockets gladly. What would you be willing to pay for the second liter of water? Well, that's enough to get you, okay, the first liter will slake your thirst. The second liter maybe get you back to civilization. So you'd be willing to pay a lot for that, but maybe not quite as much. What would you be willing to pay for the third and the fourth and the fifth? And you can see that there's this diminishing effect to how much water you want. And that actually diminishes all the way to zero. At some point, it's actually a burden. You don't want any more water, and you wouldn't not only wouldn't pay for it, you wouldn't even take it if it was free. And did we lose connection?
Yeah, Kevin, I'm not sure where he is though. His camera's off him, right?
Okay. Um,
But we're
so
yeah, we're still good. He'll come back.
uh, the point of this chart being that in gold, unlike water, unlike crude oil, unlike copper, unlike any other commodity you could name, whether vitally essential like food, or whether uh, non-perishable like copper, all other um, you had it a moment ago.
Yeah, I know. And then
Sorry, I've been trying to get that chart up whilst you're talking, but it's proving a little bit difficult. I keep going.
why it worked. We saw it. We were seeing it.
Yeah, you had it for a moment, and then it
I
went
had it
away.
for a moment and then it disappeared. I know. Yeah.
Um, Anyways, unlike any other commodity, the price or the excuse me, the utility of gold does not diminish. And what that means is people are willing to accept the nth plus 1 ounce of gold on the same terms that they accepted the nth ounce. There you go. Um, and that this is unique to gold. There's nothing else that comes remotely close except silver, which is remotely close. That's not quite true in silver, but it's much closer to being true in silver than certainly copper, iron, aluminum, crude oil, et cetera, et cetera. And when you start to ask yourself why, well, gold has a lot of value density, it doesn't perish, it's infinitely divisible, it's recombinable, it has all these properties that fairly unique. To gold is extremely heavy. If you ever held an ounce of gold in your hand, it's much, much, much heavier than has any right to be. Astonishingly heavy. And so what this means, and we can see this today, after 5,000 years of accumulating gold without any apparent limit, we still continue to accumulate. Gold is not consumed. Whenever it's manufactured into something, it can always be, if that thing that's manufactured into, suppose somebody makes a gold candelabra in the 18th century, and now today we don't burn candles for lighting, not primarily anymore. If the candelabra is not needed or wanted anymore, you just melt it down and it becomes bullion again. So gold is not consumed, gold is not lost, it's too expensive, it's recycled. That means that virtually all of the gold ever mined in human history is still in human hands. Somebody still has all of that gold. And we continue to accumulate more. The miners put out over 3,000 tons a year, which the market happily and readily absorbs without any collapse in the price of gold. And any other commodity, if the stocks increase 1 or 2%, it's called a glut. And then the price collapses until the glut is worked off, but not in the case of gold. And so that is the preface to the following comment that gold is economic constant. If you said something was 242 ounces of gold in, what was the start of your chart, 1970 something?
75, I think, yeah.
1975, and something was 242 ounces today, that's the same ounce of gold with the same value. And you can actually directly compare historical prices to current prices if you measure them in gold. If you measure them in government debt paper, then, as you say, it appears, it's the illusion of going up 1,000%. The house went up somehow. No, it's still bolted to the foundation. Nothing went anywhere. It's the currency went down, and gold gives you the clearest. People try to measure the currency using consumer prices. We call it, CPI inflation, but gold gives you the clearest picture of the decline and debasement ultimately of the currencies.
We do it all the time there. We compare everything to gold. Like, let's say I want to go long, I don't know, A, B, C, D, whatever instrument is. Okay, fine, but price it in gold, because if you're not outperforming gold, which is like the constant, then why going long that instrument? You should just be holding gold, right? You want to always outperform gold, right? Because gold is a constant, it's just preserving your purchasing power. It's a great
Well,
measuring stick.
that goes back to that chart actually. If I just get that chart back on, and I'll be a bit more efficient with my screen sharing this time. That goes that goes back to the house prices in gold, because if you're wanting to invest in property um, and residential property, then a good time to do that is when the residential property is outperforming gold. In other words, when this chart is moving to the upside. Now, as a technical chart analyst, you could identify a breakout down here somewhere. There's some sort of declining resistance line. There's also some sort of horizontal breakout level here where the price kind of consolidated for a long period of time. So you can use different types of technical analysis to identify points on the chart where you could take an entry and buy residential property and ride the move up, and you stay in residential property until it starts to break down versus gold. And again, you can draw support lines, moving averages, but very clear breakdowns. It's cyclical behavior going on here. You know, you've got sort of capital sloshing from one sector to another, whether it's commercial real estate, whether it's residential, whether it's commodities, whether it's tech and NASDAQ or cryptocurrencies, whatever it is. These cycles and this sloshing around the money from one sector to another, to use a technical term, sloshing around, is clearly identifiable, and money enters a sector and then it leaves a sector. It doesn't mean that the sector is particularly correlated. It doesn't mean there's a particular correlation between property and gold, or between gold and cryptocurrencies. But what you can identify is the bull markets of one instrument versus another. And of course, using gold as a constant, stuff tends to return back to some sort of sort of base where from whence it came, because gold is tracking loss of purchasing power. And in a way, houses are tracking loss of purchasing power, I suppose you could say, because anything priced in the US dollar is going to be tracking that loss of purchasing power to some degree or another, whether it's a can of beans, a loaf of bread, or a bottle of milk. They're all tracking our loss of purchasing power. It just so happens that gold is convenient and nice and shiny, and is also finite. It's not infinite. You can't just create it. So it so happens that gold lends itself to be a particularly good measure of that, and silver to an extent as well. I mean, what are your views on silver, Keith, in relation to gold and monetary metals?
So I was going to say, first of all, my comments on that chart, it's just breathtaking that after 50 years, the price per house is exactly the same as it was. I mean, is there a more eloquent case for the constancy of gold than that chart? And then also it was interesting, and I couldn't quite see the red edge, I couldn't quite see the price scale. It looks like from the low, the price of gold was, I'm sorry, the price of the house was 115, I guess, ounces. And then the peak was what, 500 or something like that. So there's
these are ounces on the right hand scale here. So yeah, it stretches from 115, 120 up to around about 800 at the absolute peak.
Yeah, so the price of a house does move dramatically, priced in gold. Of course, I would look at it and say 1981 to let's call it the incipient start of the financial crisis, 2000. When did they start hiking rates? 2005, 2004, 2005. It was a period of falling interest rates, which of course is what you'd expect you'd expect that to drive asset prices up. And so you see that even in gold terms, the falling interest rate makes the net present value of the income on a house greater. Now silver is a little bit different. Silver has always been the junior money, and I think the question that's screaming out to be asked and answered, if one approaches this as a scientist, is why are there two monetary metals, gold and silver, when markets tend to be winner take all, and when there's a network effect, they tend to be winner take all. There's one networking protocol, it's TCP/IP. And for the early part of my career, I was in computers and software. There were all kinds of networking protocols. There was Novell NetWare, IBM NetBIOS, various other things, Banyan Vines, if people remember that.
Token ring, IPX, SPX.
That's right.
Remember those? Yeah.
And one of them won and all of the others lost. But gold and silver were stable co-monetary metals for thousands of years. Why is that? And well, okay, silver is smaller, you can do smaller transactions. It's not really that satisfying to say that. And when you look at it from a perspective of spread, spread is so money is an indirect medium of exchange. So let's say I produce shoes and you produce food. If I have to do direct barter, I come to you with my shoes. I'm hungry. I come to you with my shoes and say, here's a pair of shoes. I'd like to trade for some food. Well, okay, the shoes on your feet are worn. You'll do the trade. Well, tomorrow I'm hungry again, but tomorrow you have a 1-day-old pair of shoes. You don't need another pair of shoes. So trade is not going to work if it has to be direct. I have to find, I mean, we both have a problem, but I have a bigger problem. I have to find some indirect thing that if I trade my shoes for that thing, I know that anyone that I want to get anything from will be happy to take that thing. And markets have gone through, salt and cows and all kinds of different things to finally arrive at gold and silver. And as they go through those different commodities, what they're doing is they're finding something that is more marketable, which means its bid offer spread is tighter. The bid offer spread is the measure of the loss you take to buy into it and then sell out of it. The bigger the bigger the spread, the bigger the friction, the bigger the loss. Everybody has a powerful incentive to find the most efficient thing, which is the monetary good. And it turns out that although gold is the most marketable, meaning the tightest bid-ask spread in commercial quantities, silver is the thing of tightest spread in wage earner quantities. If you're working for wages as let's say a skilled tradesman, let's say you're a plumber, bricklayer, whatever, how much would you want to save of your weekly wage? It might be on the order of $50. And if you want to buy $50 worth of metal, silver is more efficient. $50 worth of silver, it's a tighter spread than some tiny, 1/40th of an ounce, sliver or chip of gold, as you get those little sturdy cards with this little window, and there's a tiny little thing floating in it, 1 gram of gold. You almost lose that in the lint in your pocket. And so, silver, 50 ounces of silver would be a couple of 1-ounce coins. It's big. It's, and so silver is most marketable in the small. Gold is most marketable in the large. And so it's the most marketable good, the one that has the tightest spread, which is just simply another reflection of the same thing that marginal utility either doesn't diminish in the case of gold or diminishes certainly much more slowly in silver than it does in anything else. So silver is another monetary metal. There certainly has been a trend since the early 19th century of demonetizing it. That has been both government policy and I think sort of the natural tendency of people. It's become more efficient to make more precise, smaller units of gold. Today you have Orem, goldbacks, you have all kinds of, obviously digital gold on account. You have all kinds of different ways of owning small amounts of gold. Does that eliminate the need for silver? I don't think so, because I think there's no substitute for having a stack of metal in your hand. Both emotionally and also economically, it serves a different purpose. Holding that metal in your hand is your way of opting out. I don't trust anybody. I don't trust anything. And I don't trust the rule of law necessarily. Give me something, I can hold. And, for billions of people around the world, that is, very real and very immediate.
There is something, I have some silver coins and my kids there, they held it and something, I don't know, instinct, animalistic, they held it, it's shiny, like you said, it's heavy, and you see something in their face, there's a reaction to holding that metal, right? It's like, you're holding something special when you're holding a gold coin or something silver. I don't even have to explain it I just give it to somebody, hold it, and they're gonna be fascinated with it. There's something that humans are attracted to that for. Is it because it's an element on the periodic table, but all the other shiny qualities? But
There you go, Pat.
wow, oh my, you're so strong, Kevin. You know how heavy that is?
Well, unfortunately, it's
Because
you think somebody scammed me on that
12
one.
kilos. Keith was doing the math. Like he knows exactly how much that's worth, right? He's like, oh my God. He's just leaving that lying around. Oh my goodness.
Dear.
Well, I want
But
to,
you're right. It does, holding
Check. Yeah.
1 ounce, even 1 ounce gold coins and silver coins in your hand, it does feel quite special, doesn't it?
Check this out, Keith. Even silver, this is silver since about 1861, or yeah, it starts about here, like a long time ago. So that's oil in fiat, oil up and up, price in fiat. But look at oil, a barrel of oil price in silver, even silver within its bull runs. And what's fun about silver, because it wasn't pegged, you have more like granularity of the movements prior to
Yeah, yeah.
1970. But look at that. It's practically the same amount of silver you need to purchase that same barrel of oil. So when I saw that chart, I said, okay, silver, it's still in the game to preserve your purchasing power over long periods of time. It is more volatile, but if you hold it long enough, you're going to protect yourself. That same ounce is going to be able to buy you that same barrel of oil, right? It's bonkers. Okay, here are the ounces on the left hand side, and this is the oil. I just want to share that one and maybe one more. It's gold and oil versus oil since 1952. Yeah, this here they were tracking pretty much, and then after that there was a rupture, but gold was is still able to purchase you the same amount of oil, if not slightly more.
Yeah, it looks like
And
the price is going down in gold terms.
yeah, in gold terms, it's outperforming oil. It should remain constant, I believe, over long periods of time, but it's been going down a little bit. So maybe there'll be a readjustment over long periods of time, but it's not as skewed as it is price in fiat, right? Anything price in fiat just looks, you know. But I think you mentioned that a while back. It was like the Argentinian, like any stock market where they have a lot of inflation, everything, like everything's going up, right? It looks great, but it's tough. I
And then the
was
government charging you a tax on that alleged gain.
Yeah,
That's the real fun part of it. Oh, you got 1,000% gain, and now we're going to charge you a capital gains tax at 30 or 40%.
goodness. That chart there, I want to circle back before I forget it. That chart where you have it, an ounce of gold is an ounce of gold. And goodness, I've been in some arguments on Twitter. Patrick, you don't measure Bitcoin in fiat. Not a Bitcoin's a Bitcoin. And then I was trying to wrap my head around that. Something quite didn't make sense. So I'm sure you've heard that argument. For you, does it work or does not work? That argument that a Bitcoin's a Bitcoin. It's like,
It's Schrodinger's argument. When I go on Twitter and I say that the Bitcoiners disingenuously say that everything should be measured in Bitcoin because they want to say that Bitcoin is digital gold. It has all gold properties, right? Only better. So yeah, you absolutely measure economic value in Bitcoin. When I say that Bitcoiners claim this, I mean, it's such an absurd thing to say. They say, Keith, you're straw manning it. I mean, come on. You're trying to make Bitcoiners look so dishonest and so stupid. Of course, no Bitcoiners are saying that. But whenever I say that economic value is measured in gold, the Bitcoiners all come out and tell me it's measured in Bitcoin. And so they do say it. I'm not strawmanning. They really do say that. Large numbers of them come to my threads every time there's a thread on this, and I say this. And I always say, does anybody really believe that we have had a hyper deflationary, hyper collapse since 2009, where let's say a decent new, Honda Accord has gone from, 30,000 uh, units down to, 0.7 units. I mean, look at every business. You think every business is utterly wiped out, ruined, collapsed from millions to pennies. I mean, nobody really believes that. Obviously, Bitcoin is incredibly volatile, and which is the whole point, right? I mean, they buy it because they want it to go up, not because they think it's a constant. And there's a lot of rhetoric, a lot of hot air around all these topics. But if you just sort of stick to a scientific approach, you just look at this, in a certain way, then you cut through all that, and that's what that 1 ounce of gold, really referring to the non-diminishing marginal utility, the tightest bid-ask spreads. And we haven't talked about greater stocks to flows, but that trinity, they're all really different aspects of the same thing, which is it's money.
what
Yeah, and of
about
course you can't have, if something's going to fulfill the role of money, you can't have that level of volatility. It just wouldn't
yeah.
you wouldn't fulfill that role. You can't be sort of having an exchange rate for goods and services that doubles in the space of 12 months or falls 50% in the space of 12 months. It's just far too volatile,
For
isn't it?
12 hours.
Well, yeah, of course, it can do that quickly. I mean, Bitcoin tends not to be quite that volatile, but you get my drift. And certainly, other cryptocurrencies are even more volatile. But falling from 69,000 down to where was it, 16,000, then back up to 50,000, and then back down to 30,000. It's just not got the level of stability. And if it had the level of stability, then I dare say it would lose a lot of the appeal, a lot of the luster, and the crowd would move elsewhere. It's just which for me kind of proves that it's a speculative, potentially speculative bubble, but it's certainly speculation, and it's more tech orientated than it is monetarily orientated.
One of my favorite thought experiments with Bitcoin is, a lot of the Bitcoiners seem to implicitly, they don't really say this outright, but I think this implicit premise that there's some magic right price, and that Bitcoin is going to continue to skyrocket until it hits the magic right price, and then it will stabilize. And so I said, suppose there was a magic right price, and let's, for argument's sake, let's call that $1 million. What should you do if you're a speculator when Bitcoin hits $1 million? Okay, I mean, the gains are over. You should sell it and find the next bubble that's, still in the inflating stage and jump into that. Which means that as soon as it hits $1 million, there's going to be a whole lot of selling. Which means that if you're a speculator and you realize that all that selling is going to happen at $1 million, you should actually defect earlier, appeal to game theory here, that he who defects earliest defects best. You should actually sell at 999,000 something, which means the next speculator, realizes that, and they should defect at 998,000. And when you go through the full regression of this thought experiment, you realize there isn't a stable price. That long before it gets to that point, you might as well sell at 900,000, because now at that point there's only 10% gains left. And if you're a speculator looking for really big gains, you're not looking for something that can have 50% downside or 10% upside. You're looking for things that have 1,000% upside and only 10% downside. Well, Bitcoin at 900,000 in this scenario wouldn't be that trade anymore. So which means there's going to be selling pressure. Even if the magic right price was $1 million theoretically, they're still selling pressure at 900,000. And so it'll never be stable. It'll just bounce around, which precludes it from being used, let's say, for finance. The thing that most people don't really think about is that all the goods and services we take for granted today depend on companies being able to borrow money. And if you really try to prohibit the borrowing of money, you're going to collapse the economy down to sort of medieval times, when we had these little villages surrounded by subsistence farms, and in the village you have a blacksmith and and if you were lucky, a cooper and a cobbler, and maybe a weaver in a bigger town. Nothing larger than a family workshop, because they can't raise capital. And if Bitcoin were the only money, there'd be no way to raise capital in it, because why should you either buy the equity or something that's going to hyper collapse, or lend? If you lend, 1 Bitcoin and the value of Bitcoin goes up 1,000 times, the debtor is bankrupted, and the Bitcoin goes down 80%, then obviously the lender is ruined. And so it precludes its use in any kind of finance capacity, and relegates it only to just purely a betting market. To which I say, have at it. I don't think it should be illegal. Have at it. You want to go bet, go bet. And for those that are successful at that, good on them.
But can we say that at least Bitcoin, even if they did it clumsily, at least it brought eyes to what sound money is actually? The Fed, like that maybe is probably a positive, right? Because now a lot of people that were upset with the system, now and because Bitcoin's like millennial friendly, I don't know what you call the new generation there, but and then they probably started doing research that, they're more educated than my generation was, or on what gold, the destruction of purchasing power and et cetera. There, maybe that's a positive.
Yes, it certainly brought the monetary conversation to the fore. Whereas previously, as soon as they say the word money, I mean, what a buzzkill. And it brought millions of people to be thinking about these issues, and for that was really good.
Yeah.
Really.
Just thinking about what you're saying there about Bitcoin, about gold and silver. If you were holding, if you had to put all of your capital into say two instruments and hold for the next let's say 20, 30 years, where would you do you have a particular preference? Gold, silver, Bitcoin, um, commodities generally, stock market, um, or anything else? What would your sort of preference be? When it comes to finding somewhere to park your capital that is not just safe but likely to perform well.
You mean you have to park it and no trades for 20 or
No
30?
trades, just leaving it for, well, let's say not quite as long as say 30 years, but let's say a decade or so through until the mid 2030s. You got a particular sort of theory about what's likely to perform best?
I'm expecting a big credit event. And something, I mean, it'll be very different from 2008, because I think in today's Fed looks at the 2007, 2008 Fed as being asleep at the switch, asleep at the helm. And so I think today's Fed is hyper proactive. They're looking for the slightest sign of stress anywhere. And they're there with some sort of program, lending facility, bailout, moral hazard, whatever you want to call it, to try to tamp it down. But they have hiked the rate of interest massively. And now people say, okay, but on a historical basis, the interest rate is still low. Maybe, but I don't think you can compare the interest rate today to the interest rates in 1984 or 1974. Every time the interest rate changes, that is an incentive to participants in the market to change what they're doing. And we had 40 some odd years of falling interest rate from 1981, depending on how you measure it. Every time the interest rate ticks down, that is a fresh incentive to borrow to add productive capacity. If you're a hamburger chain with 57 stores, and you always have a spreadsheet in your back pocket to open the 58th store, the marginal store. But that's red ink on that spreadsheet because expenses are greater than revenues. Well, the interest expense is one of the big expenses in opening a new store. If they lower the interest rate, that marginal store suddenly ticks from red ink to black, and you build that store, as do all the other hamburgers, chain owners, as do the manufacturers of hamburger grill equipment, the manufacturers of plate glass for windows and everything else. Everyone's business case, ticks green. So what happens is that the rate of return on capital across the economy tends to be pulled down. So the cost of capital across the economy is just, the centrally planned, administered, interest rate. So you have 40 years of the interest rate ticking down, 40 years of that pulling down the rate of return on capital. Now you want to hike the cost of capital. All you've done is you've just pushed it above marginal return on capital, way above. And being above, what happens when a business's cost of capital is greater than its return on capital, that business is headed into big trouble. And so I just don't think these rates are compatible with the continued existence of vast swathes of the business sector. So we did on our podcast in October, was this October 2022, was Zombie Month, and looking at the phenomenon of zombie corporations, which are defined as corporations whose profit is less than their interest expense. And so this is was this February, sorry, October 2021, I don't remember. Anyway, it was, I think, before interest rates had started to be going up. And at that time, before interest rates were going up, something like 20% of all the corporate debt was already zombie.
Oh.
Now we've hiked the Fed funds rate from essentially 0 to over 5%. That brings a lot more companies that didn't used to be zombies now into zombie territory, depending on when their debt has to roll and the rates reset and all kinds of other terms and conditions. Banks, I'm sure, are working with them to extend and do all kinds of stuff. But when it finally hits, I think there's going to be a massive credit event. That credit event will be called recession and high unemployment and stock market crash and all these things. And so if you're talking about putting money today at today's high stock market prices and be, stuck watching it for 10 years, I don't think I'd be a big fan of locking my money in the stock market for 10 years.
Yeah, I mean that's the 10-year yield chart on the screen there. Hopefully you can see that, and it does illustrate what you're saying there. 40-year downtrend with a classic false breakdown on the technical chart that reversed rapidly and broke out above what I called the pain line there, because not being an economist and just simplifying things myself, I just theorized that once you break out above what has been a 40-year resistance line, the reason that resistance line is there in the first place, there must be a particularly good reason for it to be there, i.e. that anything breaking through that is going to cause issues for the economy at large. And that's, of course, to do with the growing pile of government debt, the constant creation of new debt, and the fact that if interest rates break out above that pain line, as I've called it, then there becomes perhaps an issue with long-term sustainability, and you start to see sort of tremors spreading out through the economy and through the financial markets. But where that's going to lead, we don't know. But you can look back at the 1960s and 70s, the last time that happened, and we broke out above a similar resistance line there, and that led to a couple of decades of rising 10-year yields, Fed funds rate. We saw the debt to GDP falling from 70 to 31%, whilst the rates rose up to 16.39. But of course, now, rather than debt to GDP falling, debt to GDP has actually risen from the 31% there at the peak to 129% or thereabouts now. So it's a different dynamic. We've got a very different debt to GDP ratio, whilst the 10-year yield has broken out in that environment. So the environment that we're in is a little bit like the 1960s, but we've got a very different debt to GDP environment. I say I'm not an economist. I don't know what that means, but to my sort of logical way of thinking,
it means there's a more unproductive debt. That's just a dead weight burden. And then to be paying higher and higher interest rates on that is not going to work.
No. Well, mathematically, it doesn't work for very long. So mathematically, something's got to give.
But we know, Kevin, this is what I think. They're just going to destroy purchasing power, right, Keith? I don't know how to get out of it other than destroying the fiat, right? How do you get out of this thing?
Well, I think interest rates are going to collapse back into the falling trend. I think the drivers for that trend are still in effect, which is a diminishing. So the other graph, Steve, did you email both graphs? No. You email the other one. It's looking at a concept called marginal productivity of debt. So marginal productivity of debt measures, it's the thing that everybody tantalizingly talks around. Well, we just have more pro-growth policies. We can grow our way out of the debt. Debt as a proportion of GDP will shrink. This is what people are trying to get at, but not articulating. And they're economists who should know better, because this is not a concept I created. This is an old concept. Marginal productivity of debt measures how much fresh GDP is added for each newly borrowed dollar of debt that's added. So it's measuring essentially how much juice do you get for a dollar of squeeze. So if things were to be sustainable, you'd want to see this being flat or rising. If you see this as a falling trend, then you should be worried that essentially we're producing more and more debt to get the same amount of GDP growth, or we're getting a diminishing amount of GDP growth for each dollar of debt. Well, that is a terrifying trend. What happens when this hits zero? And then what happens when it goes negative? That means we're adding more debt and we're reducing GDP. And there's some function of GDP. Actually, GDP is, of course, gross revenues, effectively. It's not gross revenues that service debt. It's actually net profits, which is a whole other thing. But if you see GDP is diminishing, clearly the power to service the debt, the capacity to service the debt is a function of GDP. And to see this marginal productivity of debt diminishing is a very long-term trend. The oldest data that I've been able to find to calculate it goes back to 1950. But I would bet an ounce of fine gold against a ratty dollar bill that this trend either has its origin in 1933 which was a big change to the monetary system, or 1913. One of those two, probably 1913 if I take a guess. I just don't have the data to prove it. Did you receive the email? Can you put up the graph?
Yes, I think so. I'll just have a little look for you. Oh, yes, there we go. Um, Gotta download it at my end first before before I can get it on the screen. So you just bear with me a moment. Okay, I've got that on the screen now, so I should be able to share my screen. I've got three screens at this end, so I'm just making sure I've got the right one. Here we go. Is that the one?
That's the one. And you can see it completely falls off the bottom in the global financial crisis. This should be a terrifying chart. People grasp what that really means. And of course, to be sustainable, you'd really want to see this number be greater than one. And, let alone, not only is it less than one, but it's diminishing. This should not be diminishing. But, it intuitively makes sense. If the government borrows $1 and spends $1, you get $1 of GDP. But after that, you have the dead weight forever. And whatever the interest rate is the government pays on its debt, you have to add that much of the debt every year, which adds nothing to GDP. You're just servicing debt. And as the government law consumes, what's really consuming is capital. As it consumes the capital on which our civilization, stands, you get this increasing lethargy. The economy employs, a smaller percentage of the population. I'm sure you guys have seen the charts. I didn't have one prepared of labor force participation and how many people are not counted in the workforce in the United States. I don't know if this data is available for other countries. There's like 100 million people that are working age and not counted in the workforce. So they're not considered unemployed. They're in a different bucket. They're in the bucket called we don't count you because it's inconvenient. And why is that number rising all through the 2000s when the economy was supposedly really good through 2008, and obviously post 2008, that number continues to rise. People just dropping out, getting on something like disability to just collect a check to do nothing. Well, all that payment, okay, every time you pay those people and they spend money to buy groceries adds to GDP, but clearly that's an unproductive, unsustainable sort of borrowing. Just like, did you get any richer if you max out your credit cards to go to Las Vegas on a bender? No, you didn't get richer. You added a lot of debt and you had a lot of fun for a week. And then you have the hangover, and that hangover lasts decades.
And therein lies the sort of catch-22 of all debt-based monetary systems. That is presumably the precise reason why there isn't a debt-based monetary system, paper currency system that has survived the test of time. And we've seen multiple currencies fail throughout the years in multiple jurisdictions. Of course, the US dollar is in a slightly different position, being global reserve currency, but there again, global reserve currency has moved around from country to country through history. I think it was the British pound was the most recent one, wasn't it, before the US dollar? And of course, that didn't end well. So there seems to be an inherent flaw in debt-based monetary systems whereby they're just not long-term sustainable purely because of the way that they operate. Is there a way of having a debt-based monetary system and you're constantly issuing new debt that doesn't end up in some kind of fatal spiral? Mathematically, I looked at it and I can't really figure a way that that is going to work long term unless you peg your currency to something that is entirely stable. It's a little bit like a ship bobbing around in an ocean without any kind of reference point, any kind of anchor. It's not held to anything solid. You're left to drift at the mercy of those who are creating the debt, those that are in control of our country's finances and the world's finances. what is the answer? What's the end game to all of this? Currency collapse? Can that happen with the US dollar? If it can happen, when would it? Quite interesting speaking to Brent Johnson, Santiago Capital, actually, about his milkshake theory. Did a chart on that a little while back, and yeah, he's got a point there. You know, the fact that the US dollar is the world's global reserve currency at the moment does give it a unique status. I mean, do you see any particular how can I put it, a particular benefit for that, you know, for the US dollar? Can you see a particular sort of longevity that the US dollar may benefit from that will allow it to somehow sidestep a complete collapse in some way, or is it going to go the same way of previous
Yeah, I mean,
currencies?
the world reserve currency and what that really means when the rubber hits the road gives it a great deal more longevity than otherwise might.
Yeah.
But in the end, there's no way to postpone it. There's no way to essentially avert it. Um, you know, Kevin, you referred, not Kevin, excuse me, Patrick, you referred earlier to, the only way out of this is to, inflate the currency. That isn't really a way out because, sure, each dollar may be worth a bit less, but you owe inflation is the process of borrowing more. You owe exponentially more of these dollars that are worth a bit less. You can't
Mm.
actually get out of the hole that way. So these are all just can kicking exercises, and how many kicks does that can have left in it? And I think Brent's whole point is the dollar can has a lot more kicks left in it than you think because all the other cans are running out of kicks. And perversely, people will be turning, around the rest of the world will be turning to the dollar and more importantly, putting their capital into the dollar, which gives the dollar, new lease on life. I mean, eventually you run out. Did Margaret Thatcher say the problem with socialism is you eventually run out of other people's money? Well, the dollar will have that problem last after all the others.
Mm.
So, milkshake will be vindicated in the end. And
Mm.
then right after that, dollar collapse will be vindicated. And the question is the timing. And when I was younger and newer to this economic, my first career was in software. Newer to this economic stuff, I thought, 5 to 10 years is what the system had left in it. And that was around 2010 that I thought that.
Mm.
Obviously, we've gone quite a bit longer than that. And we're still going. And then the dollar is going to keep going even longer than that. But the fact that they have more tricks up their sleeve, the fact that that can has a few good, or maybe 100 good kicks left in it, doesn't mean that you can't read the trend. It doesn't mean you're wrong to think, yeah, it's going to collapse. The debt is going up exponentially, and in fact has been since 1971. So, what does nature tell us about exponential trends? I mean, if you look at the world of physics, what's the one obvious thing that's an exponential trend? Well, it's nuclear fission, and like in a bomb, right? The whole thing goes supercritical because every time there's another reaction, it gets hotter. With the extra heat creates more pressure. With that more pressure creates more nuclear fission. More nuclear fission creates more heat. It's a runaway positive feedback loop. And then the whole thing goes boom, and it's enormously destructive, and it continues until it can't anymore because the fissile material is all consumed. There's other examples of exponential things, but they're not stable systems. So we have an exponential debt problem or cancer in the system, and it isn't going to be sustainable. It is absolutely going to come to an end, and it'll be the total wipeout of the currency. But, and I think this is Brent's point and my point that I've been making for many, many years, a lot of perverse and counterintuitive things can happen along the way, and purchasing power can actually go up as interest rates fall and as consumer demand becomes lethargic, and all kinds of things can happen. And you say, wait a minute, the dollar is losing its quality. Shouldn't it be losing its purchasing power? And the answer is, well, not necessarily in a direct step-by-step, one for one, tit for tat sort of way. The path by which you get there can be, as I said, very counterintuitive and very convoluted, because the system is just rife with perverse incentives and therefore perverse outcomes, including why would everybody in the rest of the world put all their capital into the dollar? Well, their own local currency is worse. So last fall, or last summer, I should say, really, but into the fall, I was on a trip around the world. So my company, Monetary Metals, had a lot of business opportunities in a lot of interesting cities. And so I was in the Middle East and met with a jewelry manufacturer run by an older Indian guy. I think he's had most of his career in the Middle East, but he's very patriotic, very nationalistic Indian, very pro Modi, not necessarily a friend of the US government or of America or of the US dollar. And when the topic of the BRICS currencies came up, he just started to laugh. He said, have you seen a chart of the Brazilian real? Have you seen a chart of the Russian ruble? Have you seen a chart of the Chinese yuan? Have you seen a chart of the Indian rupee? You're going to take 4 small falling currencies and combine them into one big falling currency. It's a joke. It'll never happen, he said. And that's a very perverse thing that, yeah, if you're in India, as bad as the US dollar is, now just compare it to the Indian rupee. And you understand why, if they lifted the capital controls, and India has capital controls, it is illegal if you're an Indian citizen living in India to dump the rupee and buy dollars. If they lifted those capital controls, it's also illegal if you're a Russian living in Russia. It's illegal if you're a Chinese living in China. The only one of the 4 that it is legal and has an open capital account is Brazil. But the other 3 have locked their people down and forced them to hold the currency because they're terrified, right? If you unlock them and you relax the capital controls, everybody would dump the currency, it would collapse, which you probably would. So compared to those currencies, the dollar is a bastion, it's a beacon, and a safe haven. How perverse is that? Incredibly perverse. But it's also the fact. It is what it is. This is how the world works. And so here's a guy who's nationalistic, patriotic, loves Modi, loves India, is no friend of the US. And it's like, of course it's the dollar. It is what it is.
As you say, what a perverse world that we live in, isn't it? It's very strange when you actually start thinking of it in those terms. Bizarre to say the least. Okay, Keith, I think we don't want to take up too much more of your time. It's so kind of you to speak to us today about gold and silver and about your thoughts on the US dollar, the economy, and where we might be heading. It's a mixture of fear and trepidation, I think, as we go through the next few months and years as to just where this might be leading, not just with the US dollar and currencies, but of course, global stability, the economy, and the current situation with conflicts around the world, because conflict tends to mirror instability in financial systems as well, of course. That's another topic area that is up for discussion at another point as well. But perhaps you could tell everybody where you can where they can find you and read more of your work and watch some of your podcasts as well and some of your recordings, which I've been enjoying as well myself.
So the company website is monetary-metals.com. It's funny. I will have to send you the URL to the base page for the podcast or the YouTube page. I don't have it off the top of my head. On Twitter, I'm at Real Keith Weiner.
We're going to put everything in the description in the YouTube there. So even the links to your YouTube channel, we'll find it. We'll put it in there so everybody could find your stuff.
All right, appreciate that.
It was fun, Keith. Let's catch up a little later on there and do it again there. See how things have evolved.
Sounds good. Thanks so much.
All right, man. All right, guys.
Cheers, Keith.
Take care, man. Bye, Keith.
Please subscribe, like, and hit that notification bell. Thanks, guys.